Hi, this is Todd Colvin coming to you from the floor of the CME Group. We are looking at rates and 10-year note yields. After that brief moment above 3% last week, we have trended down lower, back below 3%. We've seen a move as low as 291, and then we kind of crept back higher after the non-farm payroll number. But it seems that the market is very much in a lull here. We're trapped in that 290 to 3% range again, really unable to catch any momentum at either end of those extremes, and the market is just kind of sitting here spinning its tires in that waiting mode. Perhaps they're waiting for what happens with between the U.S. and China trade. Perhaps they're waiting to see what happens with the U.S., Israel, and Iran and the nuke deal. Perhaps they're waiting for something to kick in Europe. Or there's a lot of what ifs out there, and not many of them are dealing with domestic economic issues. Likewise, given the Fed's plan and their expectations to raise rates at the June FOMC. So a lot of this stuff that's going on, I think that's kind of keeping the bond market in check, are things that aren't directly happening here. And I think that's one of the reasons why we saw that aggressive move to 3%, and then you saw a lot of exiting. I think a lot of shorts got out of the market when we got up to 3% with the idea that, well, maybe things will come back, move back higher in price, we'll be able to get back in again. Or if it does continue to move, we can jump back in. But at this point, the risk is we hit our target. Let's wait and see what happens, especially with all these uncertainty and unclarity that we're seeing not only in the bond market, but in basically the macro market in general. And if you look at market volatility in the Treasury space, it is now down to 2018 lows, nearing the 2017 lows, nearing the 2013 lows, which are all pretty much around the same level. And we really aren't seeing any fear being priced in the market, which is another example of risk being taken off. So when you see the bond market not rallying or selling off aggressively when we hit key levels, it's because they're taking the positions off and waiting for another day, or at least surviving another day to fight. And market volatility being this low amidst all this uncertainty has to make you scratch your head, especially when you look over at the equity markets, which are seeing 0.5% to 2% wide ranges every day, and we're just not seeing that in the bond market. So the bond market acting very much like there's really not much happening, but I think it's because, again, risk coming off the table, positions getting closed. And lastly, next week, we've got 3, 10, and 30-year auctions. We've got key inflation data, which this afternoon we heard from San Francisco Fed President John Williams. They're going to let inflation run a little high if they have to, and that kind of gave the market a little sigh of relief, because high inflation typically means higher, more aggressive Fed, and that may not happen. At least that was maybe John Williams' way of saying, don't worry, we're not going to put our pedal to the metal. But still, a lot happening that could push yields higher. So a failure to get to 3% next week, if inflation's higher, if the auctions come through, after the auctions come through, would certainly be a signal that the risk appetites are just not out there to continue to get short, because massive amounts of leverage funds, which are hedge funds, have remained short through this entire process. But I think if we fail to get through 3% again, you could see them start to exit as well, and that would really be a reversal and possibly drive yields all the way as low as 285. But that is yet to be seen. Next week, auctions, and we have inflation data. This is Todd Colvin coming to you from the floor of the CME Group.